All right, well, joining me on the line today from his headquarters in Hong Kong is the CEO and founder of Puru Saxena Wealth Management. His Hong Kong-based firm manages investment portfolios for individuals and corporate clients, and he also publishes Money Matters, which is a monthly economic report highlighting extraordinary investment opportunities in all major markets. Puru, it's great to have you back on Follow the Money Weekly Radio.
My pleasure, Jerry. Always nice to talk to you.
Puru, we have really been living through a very historic time over the last week. You know, as a market observer, as a market watcher, I mean, we have been in this tight trading range now here in the United States for the last several months, and you could feel it, that something was getting ready to burst. We knew that something was coming, and sure enough, last Friday, we really began to feel the reverberations and the waves, and the sell-off came. Monday, of course, was historic. What's your take right now on this? I know that you saw this coming. You have already been expressing in some of your recent interviews that you've been feeling this way about the market, that you've been feeling negative about it. Give us your take on what you believe about the current rally we're seeing right now.
Well, Jerry, we had a very, very tight trading range since December last year, and we wrote about it, we spotted it. We are trend followers. We look at the price action. We keep our opinion out of the game as much as possible. We keep emotion out of the game. We keep everybody else's commentary out of the game as well. All we look at is price action and the market internals and the trends. And we saw that since December last year, the S&P was in a sideways grind. We had made marginal new highs, but it wasn't convincing. The market's breadth had been weakening since April. The New York Stock Exchange Advanced Decline line, the NYSE AD line, had peaked in April. The S&P 500 made a marginal new high in May, and it retested it in July. But the AD line never, ever confirmed the rally. It kept sliding. So that was a major red flag for us. And the other thing we observed, Jerry, a few weeks ago, was that since sort of May, June, the number of new 52-week lows were significantly higher than the new 52-week highs, and not on a 1 or 2 day basis, but consistently for several weeks. So that was the second major red flag. And thirdly, we scan hundreds of charts, stock charts every day at my firm, and we had observed that a lot of the sectors had already entered their own private mini bear markets. Only consumer staples, consumer discretionary, healthcare, and financials were holding up. Energy, commodities, materials, transportation, industrials, they had already broken down quite badly, and so did the utilities. So it was a 50-50 tape at best, and we were concerned that we'd been rallying for 6 years. QE had dried up. QE3 prompted the stock market to go up from about 1290 on the S&P to 2,134 at the top, and that was a 3-year rally, 2.5-3 year rally because of QE3. And with QE3 now dried up and QE not really helping stocks in Europe and Japan, we were very worried. We thought that this doesn't look like a solid market, so we were prepared for a sell-off. So we removed about 35% of the equity exposure from our book immediately, and we put on some hedges. And in this big sell-off we've seen, we got stopped out of all our positions. Our primary trend filter, which had been bullish for 4 years, has now flipped into the sell mode. We believe the market is behaving like it should be. We've had a huge setback earlier in the week, and now we are getting, in my view, a relief rally, a bear market bounce. The overhead resistance on here on the S&P is between 1900 to 2000, 2050. So as long as the prices don't go above that on a sustainable basis, I think the next leg will be down.
Very interesting. Yeah, we're kind of getting the same reading here within our own organization. And the other thing that is of concern has been China. You know, here on this program back in November, we gave a pretty big buy signal on Chinese equities. And in fact, it really turned out to be a great call. But that has been very spectacular, the deflation of that stock market over the last several weeks. Now, I'd like to get your take on China, because I know that you've been a bull on them in the past. Long term, do you consider yourself a bull on China? And short term, what are your views on China?
No, I'm not a long-term bull in China. I bought into China because our trend following system gave us a buy on the Shanghai Composite in October last year. So we put about 10% of the funds that we managed in China. We rode the rally all the way to the top. We had a big sell-off, and we got out of China, I think it was in June, with about a 50% profit, or 45-50% profit on the position. And since then, we've been out of China. In my view, Jerry, I may be wrong, but I think that the Chinese bubble is now deflating. China has a colossal debt bubble. Their debt has gone from $7 trillion to about $28 trillion US in the last 6 years. We have a huge amount of shadow banking going on in China, similar to what we saw in the US in the subprime mess. You've got about $8 trillion worth of loans related directly to real estate. $6.5 trillion worth of loans in the shadow banking system, which is essentially wealth management products, trust accounts, intra-company lending and so forth at very high interest rates. So the picture doesn't look good to me in China. And what we have seen since June is that the authorities and the policymakers in China have really panicked. And that to me suggests that they are not so omnipotent as people assume that they were. I don't think they themselves have a clue as to what is going on. They have thrown the kitchen sink at it and it hasn't worked. We've had rate cuts after rate cuts. You've had bans on short selling. You've had threats of imprisonment for short sellers. You've had about 40% of the market frozen at some point. The major shareholders in China have been disallowed or banned from selling shares for a period of 6 to 12 months. I can't remember the exact date. So they've done everything, and despite that, the stock market is falling. Now, most recently, as you know, they cut the reserve ratio and also slashed the interest rate. And what did the market do? The market fell. So yesterday, which is late in China, Hong Kong trading time, the Shanghai government intervened via an agency and it bid up stock prices. So they actively bought stocks on the Shanghai Composite to bring about a 5.5% rally out of nowhere in 30 minutes. So they are trying their best to prop up the stock market, but I think the deflationary forces in China are bigger than the government, and I don't think they'll be successful in containing this crisis. And I do believe that a big debt crisis is coming out of China.
Interesting. Puru, we had Peter Schiff on the program just a few weeks ago, and his case has been pretty much the same for a long time. He thinks that QE4 is right around the corner. Of course, the Fed is meeting in Wyoming this week. Jackson Hole will have some sort of a prognosis of what they're going to be thinking about soon. We also heard Ray Dalio of Bridgewater Associates saying that he believes that the Fed is going to loosen, not tighten. And we've even seen the former Treasury Secretary Larry Summers making the case that the Fed does not need to do anything at this point. What's your take on the Fed? What do you expect from them? How are you positioning for that?
Well, our view is that the Fed won't increase interest rates this year, and this has been our base case for the last couple of years now. We feel that the economy is too weak, the deflationary forces are too intense, and even if the Fed doesn't raise interest rates, apart from a relief rally, I don't think we're going to see new highs on the S&P. I think we have seen the top of the bull market. So from my point of view, Jerry, I really feel at this point the central banks are out of the equation. They have lost control. We've had 5 or 6 years of QE. Everybody now knows that QE is not inflationary. It is not hyperinflationary. And whilst I have great respect for Peter Schiff, I mean, the man called the housing bust in 2005 or 2006 in the US, I think he's dead wrong about hyperinflation and inflation. QE is not inflationary because all QE does, it swaps assets and adds reserves in the banking system. The money is not being loaned out into the real economy, and that's why we have a liquidity trap. We are in a balance sheet recession in most of the world. The debt levels are simply too high, and when you get into a point where the debt levels are too high in relation to GDP, and now, Jerry, we've got about 280% debt to GDP ratio all over the world. So when you get to this situation where the society is very over-indebted, you can drop rates to zero, and you can inject as many reserves as you want via QE. People are just not willing to borrow. That is the situation. We have an economic system which thrives on private sector credit creation. And for the last few years, as we have seen, we've seen deleveraging in private sectors across the developed world, even though it's been marginal, but we've still seen a revulsion towards debt in the developed world at least, and that is what is hurting the economy. And I don't think QE or further injections of liquidity is going to solve the economic problem. The problem is bigger than the central planners.
In our concluding moments here, before we conclude, I do want to ask you about some actionable ideas. One of the things that I recently heard you say on an interview, which I thought was very good because our system has been saying the same thing, is that biotech, that sector, that industry of the healthcare sector has been wildly overpriced for some time, and that could be a great shorting opportunity for people who either wanted to buy puts or, hedge against that. What are some other areas that you're looking at that could be potentially very profitable if your thesis turns out to be true?
Well, at the moment, we follow a trend-following program at our firm for all the strategies that we manage. We are completely out of stocks on the long side. We've got about 40% of the money that we manage in long-term U.S. government bonds, which is a mixture of 20-plus year treasuries as well as zero coupon bonds. We are short biotechnology. We are short industrials. We are short the technology, the NASDAQ 100. We are long the U.S. dollar. I feel that if this thesis of a bear market rally plays out and the stocks don't go to a new high anytime soon, there will be another leg down of panic selling from investors who have been conditioned to buy the dips over the past 6 years. And I may be wrong again because nobody knows the future for sure. But according to my experience and our method of following the market action and the tape, I'm pretty sure that we are in the early stages of a downtrend of a bear market. So the biotechnology bubble is a huge bubble, Jerry. I did the work on it myself. I looked at the IDB, which is the biotech ETF. And if you go to their website, which is iShares, I believe, and your listeners can do that, you can go up to iShares website, look at IDB, look at this PE ratio that they advertise, and then there is a small exclamation mark next to it. And if you click on that, it says that this PE ratio is based on those companies which are profitable, and we have excluded all the other companies in this ETF which don't have any earnings. So that for me was a big alarm bell. I went onto their holdings list. I pulled up the spreadsheet myself, went on to Bloomberg and Morningstar, plugged in the numbers for all these 145 odd companies in this ETF. 110 companies, Jerry, have no revenues and no earnings. 110 out of 135. So these guys are advertising a PE ratio of about 30 or 35 based on 25 or 30 companies out of a universe of 140, and then they claim that the PE is about 35. I would argue the PE is north of 400 on the biotech sector when you include all those companies which have losses. And this, in my view, is a big bubble, and every bubble needs some hysteria and hopium. And in 2000, we had this huge craze about the TMT sector, where everybody was convinced that the internet was going to save the world. Well, this time around, everybody's convinced that biotechnology is going to cure all the ailments facing mankind. So I don't believe that. I think that a lot of froth has been built into the sector. The index itself has appreciated by about 650% in the last 6 years. So it's a classic parabola up. And when these parabolas break, then you have a parabolic down. So you have a perfect bell curve, and that's what I'm looking for.
Very interesting. My guest today, Puru Saxena. Puru, you produce a monthly economic report. Why don't you tell our folks about it and how they can learn more about your work?
Sure, Jerry. I produce a monthly report called Money Matters, which is a blend of technical analysis of trends of the various financial markets. So we give out actionable advice to our subscribers on stocks, commodities, precious metals, currencies, and bonds. We also provide a brief overview of the macroeconomy, of the factors which we feel are affecting the markets the way they are. And this is sent out on a monthly basis to subscribers. In addition, we also send out timely weekly updates or weekly alerts to our subscribers every Friday Hong Kong time, which covers the market action and again covers the shorter-term movements in the markets. And all this is available from our website. If your viewers and listeners would like to subscribe to the newsletter, they can go to my website, which is www.purusaxena.com, and you can pay for it online using a credit card.
We'll place a link to your website on our website in the show notes today. Puru, I want to thank you for taking time out of your busy schedule to talk with us, and I really appreciate the great information.
Well, thank you so much, Jerry. I hope I'm wrong, but our system tells us that some trouble lies ahead.
Got to trust the system. Thank you very much.
Thank you very much, Jerry. Always a pleasure.